Our next speaker is Scott Sumner. Scott has a PhD in economics from the University of Chicago. He then taught economics at Bentley University for 33 years. And since 2016, he has done research on monetary economics at the Mercatus Center, which is affiliated with George Mason University in Virginia. And Scott's paper is called, got a great title, The Great Forgetting: Is Inflation Caused by Irresponsible Monetary Policy or Excessive Monetary Growth? Excessive money growth, I should say. So Scott, many thanks for your paper, and the floor is all yours. Like Victor, you have 25 minutes.
Okay, thank you for inviting me. Actually, I have a new name for the paper, but it's going to focus mostly on my views on monetarism and where monetarism is going. But I will talk somewhat about this issue in the title at the end of my discussion. So what I'd like to focus on first is a couple of basic issues. Why has monetarism become less popular in recent decades? Is this rejection of monetarism by much of the profession actually justified? And not surprisingly, I'll answer no. And how can monetarism be revived as a way of understanding monetary policy? So to understand this, I think we have to start with the basic reality that monetarism is most popular when monetary growth and price correlations or inflation correlations are strong, and those tend to occur in very high inflation countries. So one way of understanding this problem is to look at the demand for base money as a share of GDP. The demand for base money becomes highly elastic as nominal interest rates or inflation approach zero. And you see countries like Switzerland where the monetary base is 100% of GDP, and Japan, I believe it's about 140% of GDP. And this has become an increasing problem in recent years. And this has, I think, weakened the monetarist argument in the eyes of many in the profession. Conversely, when inflation is very high, there's usually a fairly strong correlation between money growth and inflation. And in that kind of environment, monetarist arguments seem much more persuasive. So let's bring up the second chart now, if we could. Thank you. So here's a chart I came up with that I think allows us to kind of visualize the time-varying popularity of different monetary ideologies. So I've got three ideologies here: the monetarist, the new Keynesian, and the old Keynesian. And if you look throughout history, monetarist arguments tend to be most popular at high inflation rates when there's a strong positive correlation between the growth in the monetary base and the rate of inflation. This includes the early 1920s in Europe. This includes the 60s and 70s in much of the world, and so on. The old Keynesian range is a period where you have rapid growth in the monetary base and almost no inflation. So some examples of that are certain periods in the early 1930s, and of course the QE programs in recent years in many developed countries. What I call the new Keynesian range is somewhere in between. It's characterized by relatively low inflation rates, but positive nominal interest rates. So what differentiates new Keynesianism from monetarism is there's not much focus on correlations between money growth rates and inflation, unlike the monetarists. But unlike the old Keynesians, there's still a belief in the efficacy of monetary policy. So the positive interest rates make it seem like monetary policy is still effective, unlike in the old Keynesian range where interest rates have fallen to zero and there's a perception that monetary policy is relatively ineffective. Now, this kind of U-shaped graph, I think, creates problems. It creates confusion because you notice there's actually two ranges over which monetary growth rates can be very high. There's the traditional monetarist situation that you see in places like, Argentina, Venezuela, Zimbabwe, et cetera, with high money growth rates and high inflation rates. And then there's cases like Japan where there's rapid growth in the monetary base and almost no inflation. So this creates a lot of confusion as to the relationship between the money supply and the inflation rate. Okay. So there's obviously some problems here with the critique, if you will, of monetarist economics from the rest of the profession. First of all, I'm focusing here on the monetary base. And as you probably know, monetarist theories are actually based on growth rates of monetary aggregates, M1, M2, those sorts of things. And often those growth rates are much different than the monetary base, especially at zero interest rates, where you have large increases in the monetary base that are not associated with large increases, at least quite often not associated with large increases in the broader monetary aggregates. So right off the bat, you have a problem here. A second problem is that there's sort of a selective focus on the monetary base. So non-monetarists will often focus on the monetary base when they want to cast doubt about the importance of monetary policy, but ignore changes in the monetary base when it's not convenient. So let me give you an example. The various QE programs were widely viewed as highly expansionary monetary policy because they resulted in a large increase in the monetary base. And yet just a little bit earlier in late 2007, early 2008 in the United States, monetary base growth slowed sharply. In fact, the growth rate slowed to roughly zero during a 10-month period, just as the US economy tipped into recession. And yet I think you'd be hard pressed to find almost any non-monetarist economist who looked at that, paid attention to it, or cited the slowdown in monetary base growth as a factor tipping the economy into recession in late 2007. So it's clear that most economists don't actually view monetary base growth as an indicator of the stance of monetary policy. Therefore, to sort of suddenly start citing QE as evidence that citing QE as evidence that monetary policy is highly expansionary is a very ad hoc judgment that isn't really justified by the way we traditionally look at monetary policy. Furthermore, growth in the monetary base has become an even more unreliable policy indicator once interest on bank reserves was instituted. In the US, that occurred in 2008, although it occurred earlier in some other countries. And once you start paying interest on bank reserves, the link between monetary base growth and inflation becomes even weaker than before. By the way, I think it's important to note that many of the economists that first noticed the problem with the payment of interest on reserves in the US in October 2008 were monetarists who warned about the contractionary effect of this policy. Then another problem, of course, is the distinction between temporary and permanent monetary injections. Theory suggests that monetary injections that are expected to be temporary are not likely to be very effective in stimulating the economy or raising inflation. So for a variety of reasons, the profession has, I think, misconstrued the implication of these QE programs for the relevance of monetarist economics. And monetarism has become relatively less popular in recent decades, partly because of this mistaken judgment. Now, first, I'd like to list a few of monetarism's key ideas, and then second, focus on what I think the solution is to revive monetarism within the profession. As far as key ideas, I would list a number. One is that central banks can control the money supply and thus indirectly control the price level, nominal GDP, and other nominal aggregates. Second, monetary policy should be constrained by some sort of a policy rule. Third, monetary policy remains highly effective even when nominal interest rates are at zero. Fourth, a one-time change in the money supply is non-neutral in the short run, but roughly neutral in the long run. Fifth, interest rates are not a reliable indicator of the stance of monetary policy. Sixth, monetary policy affects the economy with a significant lag. And finally, seventh, the market economy is inherently stable, if not disturbed by monetary shocks. So whereas non-monetarists tend to see the economy as unstable and monetary policymakers as rescuing the economy in some sense, monetarists focus on using monetary policy to avoid creating disturbances. Now, in my view, the biggest challenge for monetarism today is how to deal with the low interest rate environment, and which I think is going to be around for quite a long period of time. And this, I think, creates something I call the inflation versus socialism conundrum or problem for, especially for conservative economists. Conservatives are known for not liking inflation, but also not liking socialism. And the problem we have increasingly with many central banks is that as inflation falls to very low levels, the demand for base money rises very sharply, and accommodating that demand requires central banks to greatly increase the size of their balance sheets, and basically leads to central banks acquiring lots of assets. In some countries like Japan, even buying equities. So this is the central problem, I think, that monetarists have to address. What sort of monetary policy is workable in an environment where interest rates are permanently at an extremely low level, at least real interest rates, and how can we make sure that monetary policy remains effective in that environment? So the goals, in my view, would be, first, policy needs to be effective even at low rates so that fiscal policy is not needed, because fiscal policy is very costly, and it's also usually implemented in a relatively ineffective fashion for political reasons. Second, we'd like to avoid large central bank balance sheets. Third, we need to address the problem of policy lags. And fourth, we need a policy that provides some sort of nominal stability, that could be inflation targeting or nominal GDP targeting, while minimizing unnecessary cyclical instability. So in my view, the solution is a sort of a three-part solution to this. First, we need some sort of level targeting regime. That is, when the target deviates from the target path, we need to have a commitment to return to the previous trend line. My preference would be for nominal GDP level targeting, but if we're targeting inflation, I think it's better to target the price level rather than the rate of inflation. The purpose of this is not just to get back to the trend line, but rather to make deviations from the trend line smaller, because if you commit to coming back to the previous trend line, then that commitment makes monetary policy more effective. So if you go into a deep downturn, interest rates fall to zero, just the commitment to return to the previous trend line effectively reduces long-term real interest rates and makes the stance of monetary policy more effective. Another option, of course, here is the payment of negative interest rate on bank reserves. My own view is we should not be paying a positive interest rate on bank reserves. I think the pre-2008 regime in the US worked much better than the regime since then. Paying interest on reserves leads to a large central bank balance sheet. However, if there is a decision to pay interest on reserves, it should be at a negative rate rather than a positive rate. Second, central banks need to commit to a whatever it takes approach to asset purchases in order to hit the target. So this is an important step, and it's also widely misunderstood. Let me just give you an example of what I think is a major misunderstanding among many economists about the what it takes to achieve a particular nominal target when interest rates are at a very low level. So sometimes people will say, in Japan, they've done a lot of QE, the balance sheet's over 100% of GDP. How much more would it take to achieve a higher inflation rate than they've currently achieved, which is only like 0 to 1% inflation in Japan in recent years? How much more would it take to achieve 5 or 10% inflation? Well, surprisingly, the answer is much less than zero. So if Japan actually were committed to a higher inflation policy, then the demand for base money in Japan would be much lower. Just a simple numerical example. Suppose the Bank of Japan committed to a policy of depreciating the yen at, say, 5% a year against the US dollar long term. So due to interest parity, a commitment to depreciate the yen at 5% a year would immediately raise interest rates in Japan 5% above interest rates in the United States. So Japan would be immediately out of the zero rate trap. Second, at a 5% nominal interest rate in Japan, the demand for zero interest base money would fall very, very sharply. And if you look around the world at developed countries, basically, if you have a relatively strong positive inflation rate or nominal interest rate, you tend to have very low demand for base money as a share of GDP, usually less than 10% of GDP. So what that means is if Japan were truly to shift to a higher inflation policy regime, they would be moving from the left side of that diagram in chart 2 to the right side. And suddenly the real demand for base money would fall sharply, and the Bank of Japan would actually have to reduce the monetary base sharply as it raised interest rates to avoid overshooting its target. So when people hear the term whatever it takes, they generally think in terms of, oh, central banks would be even doing far more than they've been doing in recent decades in developed countries. In fact, they would actually be doing much less. If you look at the Great Recession, one country that did almost no QE was Australia, where interest rates stayed above zero. And so even though it wasn't doing all these extraordinary QE programs, it essentially had, avoided the recession in a technical sense and had a better outcome than other countries. Nominal interest rates stayed above zero in Australia. Third, central banks need to target the market forecast. So policy should always be set at a position where the policy goal is equal to the policy forecast. If the goal is 2% inflation, the instrument should be set at a position where the central bank is also forecasting 2% inflation. Now, I propose using market forecasts as a guide to policy, and I have something called the guardrails approach, which uses essentially nominal GDP futures contracts as guardrails. So this is the way my proposal would work. If the Fed wants 4% growth in nominal GDP, they commit to take a long position on nominal GDP futures contracts at a 3% growth rate and a short position at a 5% growth rate. So this way, anybody in the market who thought that growth was going to come in at less than 3% nominal GDP growth would take a long position on that contract. The Fed, would take a short position on that contract. The Fed would take a long position predicting that nominal GDP growth would be above 3%. So as long as they achieve their target of 4%, the Fed would make a profit on that futures contract. On the 5% contracts, people that were worried about high inflation, high nominal GDP growth would be taking a long position. The Fed would expect less than 5% nominal GDP growth. They would take a short position. And what you would have is essentially the market guiding Fed policy. If the market was all piling up on one side or the other of the market, that would be an indicator to the Fed that policy was likely to miss, and the Fed would have to adjust policy to avoid risk of large losses in the nominal GDP futures contracts. So that's what I've been proposing as a approach to essentially implement a more robust version of monetarism for the 21st century, an environment with very low nominal interest rates and less stable relationship between money and inflation. A few comments just to finish up on the current environment. There's been a lot of debate about whether inflation is a demand side phenomena, a supply side phenomena. And in my view, a lot of these discussions are not poorly or a little bit ambiguous as to what actually is being debated. Obviously, for any given growth in nominal spending, you could say that supply problems are causing the inflation. So in the United States, nominal spending has grown at just under 4% a year over the last 2 years. That's actually pretty normal. So in a sense, you could say the high inflation is due to the fact that we have a lot of supply bottlenecks, and that normal level of nominal GDP growth has led to more inflation than usual. Alternatively, if you take the inflation target of 2% as the benchmark, you could say, given the supply bottlenecks we have in the economy, monetary policy has been far too expansionary, nominal GDP growth has been far too high, and as a result of that excessive nominal GDP growth, we have high inflation. So it depends whether you're taking the bottlenecks in supply as a given or taking the nominal GDP growth as a given. And ultimately, then, it's a judgment about what sort of policy is best. I don't think there's a clear answer to whether the inflation is demand side or supply side. What there are clear questions about whether the policy is desirable or not. So my own view is that until now, the policy has been relatively desirable. That is, the 4% growth in nominal GDP has been effective in restoring the economy to roughly full employment in a very short period of time, at a cost of some inflation, but I think that was a cost worth paying and something we should have paid back in 2009. On the other hand, all the forecasts I've seen are that nominal GDP growth will continue going forward at a rate well above 4%. In my view, that's excessive. So whereas the rapid recovery we've seen and the rapid growth in, or the recovery in nominal spending has been very effective and desirable in my view, it seems very likely to me that in the next 12 months, nominal GDP growth will be excessive. And so if that forecast is accurate, then the inflation rate that we may get over the next 12 months will be excessive relative to what would be appropriate growth in nominal GDP of roughly 4% a year. So in that sense, if you look at it in terms of policy, what's desirable, what's not desirable, I would say that I blame mostly supply side factors for the recent inflation because I view the nominal GDP growth over the last couple of years as being desirable. I expect that the inflation will be mostly demand side going forward because I think the demand growth we're likely to get over the next 12 months will be excessive, not desirable, and therefore, if that forecast is accurate, then in fact, monetary policy would be to blame for the high inflation going forward. So some temporary increases in inflation are desirable to hit other macroeconomic goals like stability and employment, but we risk overshooting that desirable adjustment in the price level with the continued growth in rapid growth in nominal GDP going forward. Thank you.